Your credit score, a bit of a mystery as to how it works. We know the higher the score, the better, but do we really know how it works, how we can build it, and what we do that can hurt it? Well, that's what we'll be talking about today. Back in a sec. Hi there, I'm Barbara McGrath, a realtor at Red and White Realty in Kitchener-Waterloo, Ontario. I post videos every Monday, and if you haven't already, please subscribe. Your credit report is a summary of your credit history. Lenders send information about your accounts to the credit bureaus. Your credit score is a 3-digit number that's determined by the information in your credit report. It shows how well or poorly you manage credit. In Canada, a good credit score is considered to be between 660 and 724. The range is between 300 to 900. What affects your credit score? Well, number one, carrying a balance is not a great idea. You owe money and you'll be paying interest on that money. Ideally, you want to pay your credit card bill in full, on time, every month to build a good credit score. Number two, regularly missing payments. Your credit score may take into account missed or late payments, how long they went unpaid, and how frequently this happened. Number three, being close to, at, or above your credit limit. Creditors look at how much you owe compared to how much debt you have available. It's called debt utilization ratio, and the higher that number, the clearer it is to creditors how much you may be struggling to pay. Number four, the number of recent credit applications. Number five, the type of credit you're using. There are two kinds of credit, revolving credit and installment credit. Installment credit is a loan that you pay back regularly, monthly for instance. The amount of the loan is set when you are approved, and the amount that you borrow doesn't change. Revolving credit, such as a credit card, is not a predetermined amount and can vary over time and is generally considered less secure. Number six, if your debts have been sent to a collection agency or any record of insolvency or bankruptcy exists. Equifax and TransUnion are the two main credit bureaus in Canada. They only collect information from creditors about your financial experiences in Canada. Those allowed to see your credit report include banks and other financial institutions, credit card companies, car leasing companies, retailers, insurance companies, governments, so they can lend you money, collect a debt, consider you for a job, provide you with insurance, or give you a credit increase. A lender or other organization may ask to check your credit or pull your report. When they do so, it results in an inquiry in your credit report. It is concerning if there are too many credit checks or inquiries in your credit report, as it might appear you are urgently seeking more credit or trying to live beyond your means. But bear in mind there are two kinds of credit checks, hard checks and soft checks. Soft checks are when you or a third party are reviewing your credit for non-lending purposes, and these do not affect your credit score. A hard check happens when you're looking for credit, and this kind of check can affect your credit rating. Most provinces require written consent to check your credit report. When you sign an application for credit, you allow the lender to access your credit report then, when your account has been approved and while it is still open. Your credit report contains personal, financial, and credit history information. In general, it takes 30 to 90 days for information to be updated in your credit report. Your credit report may contain personal information such as your name, date of birth, current and previous addresses and phone numbers, social insurance number, driver's license number, passport number, current and previous employers, and job titles. Your credit report may also contain non-sufficient fund payments or bad checks, checking and saving accounts closed for cause due to money owing or fraud committed, credit you use including credit cards, retail or store cards, lines of credits and loans, bankruptcy or a court decision against you that relates to credit, debts sent to collection agencies, inquiries from lenders and others who've requested your credit report in the last 3 years, registered items such as a car lien that allows the lender to seize it if you don't pay, remarks including consumer statements, fraud alerts, and identity verification alerts, how much you owe, if you make your payments on time or if you miss payments, if your debt has been transferred to a collection agency, if you go over your credit limit, personal information that is available in public records such as a bankruptcy. Now note that your mobile phone and internet provider may report your accounts to your credit bureau. Your mortgage information and your mortgage payments may also appear on your credit report. How do you improve your credit score? Well, number one, aim for a mix of types of credits that you have: credit cards, installment loans, mortgages, store accounts, but be mindful of opening too many accounts at once and do not open more accounts than you need. Number two, keep informed about your credit score and make sure what's on file with Equifax and TransUnion is accurate. For a fee, both these agencies will provide you with your credit score and a copy of your credit report. Number three, stop applying for credit. Number four, make regular payments. Paying at least the minimum every month or twice a month is good. Paying it off so you're never running a balance is ideal. Number five, if you have several credit cards and you're thinking of closing one or more, close the most recent one. That way you can maintain history with an older account. If there are other reasons for closing the older account, like annual fees, higher interest rates, then be strategic about when you close them. But be aware that closing an account has an immediate negative effect on your credit score because you are reducing the amount of available credit and therefore usually increasing your debt utilization ratio. Otherwise, don't close accounts. Number six, accepting an increase on your credit limit. Now this improves your debt utilization ratio immediately and your score could go up 30 to 50 points in a month. The ideal debt utilization ratio is 30%, but it's best to keep it below 10. So pay down your balance to get it within these tolerances and keep it there. Well, there you have it. Some information on credit scores and how they work, and some tips to help stay on top of it and build an even better credit score. See you next time. Take care.